Hello class, this is Brian from FinancialTrainingSchool.com and welcome to GT210 Money Management. So as the name implies, this is how you manage money. Before we manage it, we must understand it first. So everything in the previous lessons will be summarized here. So all the money facts mentioned in the psychology, mentality, emotions, all that stuff will be mentioned here. So firstly, how do you perceive money? Are you emotionless towards the value of money? I personally treat every deposit as a fixed cost or loss. Then how do you treat your trades? I enter every trading session knowing that I could lose the first or the last trade. And also treat each trade independent of each other, because there's no need to obsess on your past trades, because you should always enter your next trade neutral without the burden of the last trade on your mind. And I've also mentioned that you should care more about the consistency of trades rather than the total amount of profits. But you still need to be mindful of the changes in your account balance to alter your risk size. So, what's your source of money? What type of money are you trading with? If you ask traders, everybody's pretty much going to tell you the same thing. You should only trade with what you can afford to lose. You don't need the extra weight on your mind that will cloud your judgment, causing you to lose unnecessary trades. So there's two sides of this, prior to depositing and after depositing. So prior to depositing, you have tuition, mortgage, bills, loans, etc. This is weighted money, so you shouldn't take money out of this budget to trade with, because it has weight to it. Versus spare cash, beer money, coffee money, lunch money, whatever, leisure money, recreational money, this is weightless money. You could skip a few meals to put money into trading account, that's fine, skipping meals, whatever, one meal a day, that's fine. You know, kids do this all the time with their allowance to save up for something that they want to buy. So as adults, you can do this. Then after depositing, how do you treat your account balance? Is it plain money to you, or is it a cost or a profit? For me personally, I treat it as a cost until I get it above my deposit. And as soon as I get it above my deposit, I treat it as a profit. So these two concepts of costs and profits will be developed now. So for costs, each deposit is treated as a fixed cost. Once it leaves my hands, it's already a loss. So if I'm below my initial deposit while trading, I'm not trying to recoup the loss because it's already gone. Note, for you economic savvy people, I consider it a fixed cost. It's not a sunk cost. Sunk cost cannot be recovered, i.e. advertising. Once it's gone, it's gone. Fixed costs can be used to obtain profits and thus recover the cost. Thus, I'm emotionless towards the value of money while I'm trading. As for profits, let's give an example first. So let's say you deposit $500 into your stock account, Forex account, whatever account, and then you get your account balance up to $750. This represents a 50% account growth and profit. Subsequently, you lose $250 and now you're back at $500. And this can be viewed as a 33% account loss or break even. So how do you feel after this happens? Are you negative, neutral, or positive? Personally, I would feel neutral because I'm back at break even, because all I lost was profit, not my fixed cost. Whereas some people would feel negative because they feel like they're losing money. They don't think of it as profit, they think of it as plain money. Some would even feel positive because they only lost 33% of their account rather than wiping out completely. As I mentioned previously in GT210 patience, it doesn't take a lot to profit. You don't need that many trades to profit, you just need a high accuracy, and with time your account will grow when you compound your profits. Because money is easily scalable once you increase your trade accuracy. Aside, this concept will be developed further in the GT400 series, and you don't have to be risking a lot per trade. A low risk size means you can be wrong multiple times without any huge repercussions. You've probably heard these phrases before. Don't put all your eggs into one basket. Don't go all in, saving for a rainy day, etc. Why not? Because you need a backup plan. What happens if things don't go according to plan, or you're wrong? Everyone would like to think that they're right, but you don't control the markets. You're just going along for a ride. So lastly, the primary focus of traders is capital preservation. Low risk leads to preserving capital for the long term. This directly allows you to improve your trading accuracy, because since you're preserving capital for the long term, you have more time to trade, and thus you have more time to improve your trading accuracy. Because remember, traders are trying to maximize their gains while minimizing the losses. But the concept of capital preservation is a hard concept to grasp though, because this typically applies more to high income than low income individuals, since these people focus more on percentages. So for example, let's have two people, person A and person B. Person A is high income, they make $200,000 per year and puts aside $100,000 for trading, while person B, low income, makes $20,000 per year and puts aside $1,000 for trading. The reason why the ratio of how much they put away for trading is different is because you only need a certain amount of money to survive each year. So let's say $15,000 in this economy, that's the standard of living. So person B puts aside 1,000, which represents 5% of their income, while person A puts aside 100,000, which represents 50% of their income. So here's where the difference lies. Person A would rather risk 5 to 10% on a trade because this represents $5,000 to $10,000, while person B probably has no problem risking 50% on a trade since it's only $500. Now you could probably argue that the risk amount is the same ratio for both persons, so person A would have 5,000 relative to 200,000, which represents 2.5%, and person B has $500 relative to $20,000, which is also 2.5%, but this isn't the case because of the different income classes. You view money differently. Usually when you have a lot, you care more about what you have to lose compared to when you have very little, you care more about what you have to gain. So depending on which income class you fall under or how much money you have to trade with, you might view money management differently. But the conclusion is, don't be greedy, be patient, and the money will come over time. As an aside, the money management strategies will be covered in the other series because each individual instrument has its own money management strategy. So stocks, forex, binary options, they all have their own money management strategy. So I can't cover it here. There's no general strategy. The general strategy is don't put all your eggs in one basket. Don't go all in. You need to limit your trade size, limit your risk amount, and focus on your trading accuracy so that in the long run, you'll eventually make money. And you just compound profits. And that's it. So I hope you guys enjoyed this video, and I will see you guys next time.